Good afternoon, friends, colleagues, ladies and gentlemen. My name is Dhruv Chopra, and I am your moderator for this session today. I welcome you all to this full house on a Friday afternoon. We're very lucky to get the response that we have. We can see hundreds of people who've already logged in. So thank you. We have an expert analysis on direct tax implications on the budget 23-24, co-hosted by Dewan P.N. Chopra and Company and NA Shah Associates. As they say, if it ain't broke, don't fix it. And just let time take its course. It's a good philosophy, but most productive when you have a strategy, a vision, and resources to execute. The course of action reflects clarity, it reflects confidence, it reflects conviction. All of these traits were well present in the budget presented on the 1st of February by our Honorable Finance Minister. The vision of India at 75 as a bright star on the global arena is now a reality, with India pegged to be the fastest growing economy in the world and holding geopolitical prominence with its presidency at the G20. With due focus on sustainable and inclusive growth, India is said to be entering Amrit Kal, an era when we reap the benefits of a mature and stable macroeconomic situation, offering housing, jobs, education, healthcare, and ease of living for all. Kosha, if you may. Coming off the heels of COVID, the resilience of our nation and our economic recovery caught many by surprise. With an advanced estimate of growth at 7% of GDP, a budget estimate of deficit at 6.4%, one of the highest tax collections to GDP ratio, if not the highest in our history at 11.7%, a successful adoption of GST, with a steady state collection of 1,50,000 crore per month for the last 4 months. Urban unemployment at 7.2%. If we go to the next slide, please. At 7.2%, which is a 4-year low. And on the back of all this, we are now standing tall as the 5th largest economy in the world. Often, less is more is an underrated principle, but has been well adopted in this budget. Our finance minister has kept her focus consistent over the years with an overall strategy. The focus continues to be on capital outlay. It continues to be on capital expenditure, with a 33% increment in infrastructure expense and allocation, and a 75% increment in the railway allocation. At 4.5% of GDP, our capital expenditure planned is the highest ever. And this is set to have a multiplier effect, an effect on jobs, an effect on credit, an effect on entrepreneurship, an effect on housing, and most importantly, on consumption and growth of our people. Though this is the last full budget presentation prior to the scheduled elections in the subsequent year of 2024, the budget presented in no way succumbed to the potential political temptation of being populist or being social. Actually, it bravely continued down the path of judicious allocation of capital for long-term benefits while treading an arduous task of fiscal consolidation. And we are set to be on path for 4.5% fiscal deficit in 25-26. With this backdrop, ladies and gentlemen, may I introduce to you our two eminent speakers with a combined experience of almost 100 years in the field of direct taxes. Our first speaker today is Mr. Ashok Shah, or as I fondly refer to him as Ashok Bhai. He's the founder, partner of NA Shah Associates LLP. With a strong legal and tax background for over 45 years, he heads the firm's tax advisory and compliance practice. Ashok Bhai has been advising ultra high net worth individuals, families, corporates, and institutions, both in India and in the US, for these past 4 decades, and leading the institution that he has built over the last 50 years from the front. He has been addressing various forums on estate planning, including at ET Family Business Roundtable, and is a regular contributor with his articles across different journals and publications in and outside India. He is associated with various not-for-profit organizations and also is, but of course, a lawyer, a chartered accountant of the vintage of 1977. Ashok Bhai, welcome. My second eminent speaker today is Mr. Anil Kumar Chopra, founding partner and executive chairman, Dewan P.N. Chopra and Company. Mr. Chopra is a fellow chartered accountant and an alum of the Sri Ram College of Commerce with a specialization in direct tax advisory and litigation in international tax, corporate law, finance, and foreign exchange matters. He has argued numerous cases which have been reported time and again and have set the precedent in the field of direct taxation. He holds numerous positions in eminent committees and chambers of commerce, including as Vice President of Income Tax Appellate Tribunal, Chairman Direct Tax Association for PhD, Co-Chairman Foreign Trade and Investment Promotion PhD, Secretary International Fiscal Association, Finance, Banking and Insurance Committee at PhD, so on and so forth. But most importantly, he has the distinguished privilege of also being my father. As we move forward, may I request you to please submit any questions that you have in the chat box below, and we will address them as we go along. Time is short. We have much to cover today, but we will try and take up some of them. But more importantly, we would like to hear your issues and practical thoughts that we can take forward through our good offices to chambers of commerce. Before I pass on the mic to my eminent speakers, I'll take the liberty of addressing the first topic lined up for the day, which has garnered much interest, which is relating to changes in personal tax. Kosha? There are a number of changes in this regard, but I will focus on the one change for which we received the maximum amount of queries. On Section 115 BAC, pertaining to the revised new personal tax regime. As you're aware, there was an old regime, and then there was a new personal tax regime introduced in 2021, and this has now been revised with effect from 1st April 23. The three tables in front of you tabulate the effective tax rate between the existing regime, which is on the left side, the revised new regime, which is in the middle, and the old provisions, which is on the extreme right. There are two material changes which have been introduced in the revised new regime, which are tabled below. One is an increment in rebate under Section 87A, which is from 12,500 to 25,000. But more importantly, is the introduction of two deductions under the new regime. Standard deduction of 50,000, subject to your quantum of salary, and the second is your family pension deduction under Section 57(2)A. These two are expected to bring an advantage to the individual taxpayer under the new revised regime, which was missing in the regime that was introduced in 2021. We are all aware that under the old provisions, there were various deductions that are available of Mediclaim, HRA, interest on housing, loan, etc., which are not available under the revised new regime. However, what we would like to do, and the pertinent question is to compare the two as they stand today to see at different points of income, what would be more advantageous for the taxpayer. Kosha? So we took 4 points of income. As you looked at the extreme left, gross salary at 7 lakhs, 10 lakhs, 15 lakhs, and 20 lakhs. And at each, we compared two possibilities. One is the old provision and one is the revised new regime. So if I look at the 7 lakh income as it stands today, you will see that if we take a standard deduction of 50,000 and a deduction under ATC for investment of 1,50,000, which are the two basic assumptions to take, at a net taxable income of 5 lakhs, your amount taxable under the or tax payable under the old regime will be 0. And the same principle will apply in the revised new regime, where you now have a 50,000 rupee standard deduction, and pursuant to the 50,000 standard deduction and an increment rebate of 25,000, your tax payable is 0. So at 7 lakh rupees, you're at parity between the two. But as soon as you move to an income point of 10 lakhs, you can see that after under the old provision, after the 50,000 standard deduction and 1,50,000 ATC benefit, you are paying a tax of 72,500 as distinct from 20,000 rupees under the revised new regime applicable from 1st April 23. Similarly, at 15 lakh income point, there is a saving, as you can see in column H, of 62,500, where the tax payable under the revised new regime is lower than that payable under the old provisions. And then at 20 lakhs, the savings continue at 67,500 in column H. This, needless to mention, this is based on some basic assumptions. And of course, if we take into account various deductions that are available as we move along in the old provisions, it is a question of fact which will be more beneficial. But it is certain that the revised new regime introduced with effect from 1st April 23 is better than the regime that was introduced in 2021. Another key change is on account of the surcharge, which is applicable to the highest rate of tax, which has been reduced from 32%, 37% to 25%. So the effective tax rate is down from 42.744 to 39, which effectively means you're saving 3% tax at the upper end of the bracket if your income is above 5 crores, which for a person earning more than 5 crores is a saving of approximately 15 lakhs or more. At this stage, in context of personal tax, that is what we have to share. Of course, if you have any questions, we're very happy to have it in the chat box, as I mentioned, and I'd like to pass it on to Ashok Bhai to take this forward.
Thank you, Dhruv. And very well said. What I would in the first instance take up is the provisions which impacts the individuals. So the first point which I would like to take up is on when the gift to not ordinary resident. Earlier, what happened was that when the gift was made to a non-resident, it was not taxable. They did not bring about the amendment so far as not ordinary resident is concerned. So in this budget, they have extended that even gift to a not ordinary resident will become taxable. And this happens because the gift gets completed when the gift is received. So in order to make non-resident taxable, in 2019, they had brought in the amendment, and now they have completed it with bringing not ordinary resident. Second point which I would like to take it up is on that interest on listed debentures. Till now, they were exempt from TDS. From the current year, they have made this liable to tax. As you know that rate of TDS would be 10%. Whenever employer gives a perquisite to the employees in the form of rent-free accommodation, there were provisions relating to taxation. And typically this would be if the residence was owned by the company, depending on where the person stays, it is 10 to 15%. If it was rent was paid, then there were provisions. Now what they have done is to take upon they will come out with the rules of valuation of perquisite, which will be uniform. These are yet to be announced. Another point which they have changed is relating to taxation of market-linked debenture. Now, in last few years, this instrument had gained tremendous popularity. These are the instrument where these are SEBI regulated instruments, where the company would issue the instrument and the returns would be linked to certain parameters. The rate of tax for this was, if it was 1 year, above 1 year, it was 10%. Now, they have made an amendment to say that whatever is the return, it will be taxed as a short-term capital gains, irrespective of the period for which you hold it. So even if you hold it for a period exceeding 3 years, then also the rate of tax would be your normal tax as it's a short-term capital gains. This would impact tremendously the taxpayers who have in the recent past invested lots of money into this market-linked debenture. They would have to do their planning before 31st March 23 if they want to escape higher tax in the next year. Another amendment which has been made and which is going to impact quite a lot of people is on TCS. Whenever remittance is made outside India, the government had introduced TCS, and basically this was introduced more as a tracker, so that when a person remits the money, he comes under a tax net. The government can see whether that person has sufficient resources to make the remittance. Presently, the rate of TCS, this is reflected on the screen, that it was for the purpose of education and it is out of the loan obtained. It was 0.5% for an aggregate amount in excess of 7 lakhs. No change is proposed for it. For the purpose of education, other than the first one, that is other than out of the education loan, or now they have introduced a new category, which is for the purpose of medical treatment. The rate of TCS is 5% of the amount, which is in excess of 7 lakhs. And on this, there is no on the rate, there is no change. The next item is on overseas tour package. The rate of tax TCS was 5%, and there was no threshold limit. This has been increased to 20%, again without threshold limit. And in any other case, earlier it was 5% on the amount in excess of 7 lakhs. Now that this has been made at 20%, again without any threshold limit. So this is going to impact the remitter if they do not have a taxable income. This will be they will have to go and apply for refund. Of course, whenever this TCS is not a money which is gone away, if you have got a tax liability, it will get adjusted. Otherwise, it will get refunded. The next point which I would like now to touch, and which is also very, very important amendment which they have made, is in respect of life insurance policies. As we are aware that currently maturity proceeds from the life insurance policies were exempt under Section 10(10)(d) if the premium is less than 10% of the sum assured. Now, in the last year, they made an amendment to the unit-linked insurance premium policies. In current year, now they have extended this to life insurance policies. The way in which it works is that if you are paying premium in excess of 5 lakhs of rupees, either for a single policy or for multiple policy, and this is going to impact for the new policies which have been taken after 1st April 2023. Then in respect of those policies for which premium is in excess of 5 lakhs, no deduction, no deduction is allowed. That is when you receive the money on maturity, those amount will be taxable. And now this is can be explained by this table which is there in front of you. So let's assume that there are 5 policies and annual premium is given as either 1 lakh, 150 or 2 lakhs. And the sum assured is given in the next column. If when the consideration is received at maturity, first is the total premium which has been paid will get reduced if it has not been claimed as a deduction in the year every year. So out of this, under the column of X, if out of 8 lakhs, 6 lakhs is the total premium paid, the income will be 2 lakhs, and similarly for the other. The next question which will come up is that if we see the aggregate premium of all the 5 policies, it's about 8 lakhs of rupees, which is in excess of 5 lakhs. And therefore, it is for the taxpayer to choose which of the policy during the entire duration of the policy, the premium is less than 5 lakhs. So in our example, if X, A and B, if you add a total of the 3, it is 5 lakhs. Any premium, so you can choose that amount, and on a maturity, the income which is received will be tax-free. And one thing which is, this is going to be extremely difficult to monitor because of multiple policies which a person takes. And usually the life insurance policies are taken for 25, 30, 35 years. And at the point of time when the maturity comes up, it is going to be extremely difficult to demonstrate and maintain records that how do you demonstrate that in the respect of these policies, A, I did not take any deduction or not, B, for whether it was in excess of 5 lakhs or not. One thing which they have said is that if the amount is received on death, then this provision do not apply, and therefore it is not going to be taxable. Though this is going to be an extremely difficult proposition to manage, and let's hope that the finance minister does something to ease this out. Thank you. Thank you, Dhruv.
Thank you, Ashok Bhai. I would like to invite Mr. Anil Chopra, please, who would similarly take up a few key amendments and topics.
Thank you, Dhruv, and good afternoon, everybody. Thank you, Ashok Bhai. Just 1 or 2 points very quickly on what Ashok Bhai said. We all appreciate much good that has been done by the budget proposals. But there are a few which are of concern, and we would urge the government to reconsider them. They need modification in the larger good, in the interest of the economy, and so that there is no related hardship to the citizen. We all believe that tax should be on real income, actual transactions, and not on artificial notional deeming provisions. To say that irrespective of the holding period of MLDs will be short-term may not be the best way forward. You can change the holding period between short and long for such instruments. You can prescribe the rate of tax. But please do not say that even what is held for long will become short. And there should be a distinction between an instrument that is actually held for long, let's say under a prescribed period that may be prescribed, and which is held for a short period. On a practical front, I believe a lot of people are considering, if they've already held for more than 1 year and subject to market, it would be interesting for them to consider. It's a question of fact, and these are business decisions and market factors. I am told some people are considering divesting their MLDs fairly swiftly now. On LRS, 20% again. 20%, the money which a man is sending out through bank, through explained funds, through tax-paid funds, it is only a remittance. It could be bank to bank. 20% TCS on such sums is highly excessive, ordinarily without actually earning of income. It is uncalled for. When it comes to even the mechanics, there are instances, I am told, where a person, let's say a tour package operator, has collected such sums and not deposited it. So there should be the possibility to enable an assessee to deposit it, and procedure and process can be worked out to make this viable. These provisions of 20%, I would again very respectfully urge, need careful consideration, please, by the government. The first point I am taking up is taxation of online gaming. There has been a fair amount of dispute with respect to persons who have played. The difference between skill and gambling is there in what has been contested by both sides, and so on. And whether TDS provisions are applicable and how is this to be computed. Now, provisions have been made. So we have new provisions 115 BBJ that say net income from online gaming will be computed in a prescribed manner at 30% tax to the extent of such net income from online gaming, and on other total income as per other provisions of the Act. Such winnings, in light of this amendment to 115 BBJ from assessment year 24-25, have been excluded from 115 BB. We then have section 194 BA from 1st July 23, where there will be TDS on net winnings from online gaming at 30% at the time of withdrawal or on the balance at the end of the year. This will be charged irrespective of whether it is in cash or kind. And the government has been given powers to CBDT that, subject to prior approval of central government, they may frame guidelines for removing difficulties. So some amount of clarity will now come on taxation of online gaming. In 194B and 194BB as it was, from 1/4/23, there was this issue that will this tax be required to be deducted only if the transaction is 10,000 or if the aggregate sum is 10,000. The Act did not say aggregate sum of 10,000 in a financial year. That has now been said. So if someone makes such income of more than 10,000 in a financial year, then TDS liability will be there from 1/4/23. I then move on to startups. Here again, we are very happy to see that the date of incorporation of a startup has been extended under 80 IAC from 31st March 23 to 31st March 24. There is also an extension for carry forward of losses to make the provisions consistent with 80 IAC. So carry forward of losses for 10 years. But the provisions of section 79 are there. And these provisions of Section 79 are very difficult to fulfill. Vis-a-vis 51% continuing as in year of loss compared to the year when the adjustment is being made, or saying that all the shareholders in the year of loss, the original shareholders, should continue to hold the shares in the year of adjustment. It is very difficult for all to continue to be there. And there are so many aspects in startups, the very reason that special treatment is given to them. What about stock options? What about the right to have certain interest under certain circumstances between the parties and associates? This is not going to be of great use if 79 is there to extend it from 7 to 10 years. There are certain situations where the Act prescribes that 75%, for instance, of the shareholders should be the same. Certain business reconstructions, for instance. If at all this provision is to be there, that for original shareholders they should continue, then not 100 but 75% may be considered, please. Next point, preventing misuse of presumptive tax under Section 45BB and 44BBB. This is to close misuse, which is fair enough. And it says that once you have adopted taxation on a presumptive tax basis, in the conditions which are applicable to these two sections, then you cannot say, I will pay tax on presumptive tax, but I will seek adjustment of unabsorbed depreciation and brought forward loss. So that will now not be allowed. This is some assessment here, 24-25. Another welcome move, MSMEs, Section 43B, to help create working capital, to help them to operate efficiently and receive their fair sums of money. Amounts due to them are to be paid to them within 45 days of written agreement as per MSMED Act. And if that is not done, then it is not only going to be allowed on payment basis. There is a clarification that the mere fact that it is paid after 31st March, but up to due date of filing of return, will not entitle an assessee to get this deduction. However, if it is paid after 31st March, then in the next year, he would get the deduction, assuming payment after 31st March is after the due date. Simplification, ease of business, part of government policy, part of the announcements of our finance minister. So, increase in presumptive tax, which many people are seeking under Section 44AD and 44ADA. Now, presumptive tax here on small, medium businessmen and professionals is very welcome. You have your turnover or gross receipts as per your GST return. You do not have cash transactions of more than 5%. Transactions by account pay check, account pay draft are not considered to be cash transactions. And then you would pay your tax on your turnover or gross receipts at, say, 6%, assuming your cash receipts are not more than 5%. The limit was 2%. Lot of canvassing has been done that, sir, make this presumptive tax free and readily available to a much larger segment. It will enhance compliance. And it will also release resources of the department to focus on larger cases. So some change has come. It is very welcome. The 2 crore limit for permissible business to prescribed assessees has been increased to 3 crores. Similarly, in case of 44ADA, the income which is to be taken at 50%, subject to 5% cash, that sum of money or gross receipts have been increased from 50 to 75 lakh rupees. Here also, I would request that a clear clarification should be there, that statutory amounts such as DST do not form part of gross receipts or turnover. Welcome move, will be useful for many. For the moment, I'll take a last one and then back to Ashok Bhai, please. Capital gains under section 54 and 54F. Restriction on deduction from assessment year 24-25. The maximum deduction under these two sections, which is now going to be permissible from the said year, is 10 crore rupees. And the deposit in capital gains account will accordingly not be more than 10 crore rupees. Here also, I would respectfully urge the government to roll back this provision. It needs very serious consideration. There are good reasons why sell a house, buy a house is free from capital gains tax. Sell assets, you don't have more than one house. You sell assets which are not a residential house, you buy a house, you get an exemption under 54F. Now, there is no reason to tinker with it at the higher level, because I do not think such reductions are based on the quantum. If a man bought a house paying tax-paid money for a higher sum, he will sell it for a higher sum. In all fairness, you took the tax when it was due from him, but then he sold a house, he's bought another house, he needs a roof over his head. Let him have it, which is similar to what he had before. And there can be situations of a sort of forced sale, distress sale. Two brothers used to live with their father, they no longer wish to live together. There may be no way out except to sell and buy one house each. Now let's assume they both own only one house each. So why should we restrict them, please? Did they not have that house before over there with the roof over their head? Why should that be restricted to them? I really do not see why this is called for, or how much will be the collection on something like this. On the other hand, it will be a dampener on investment in housing. And at the moment, every encouragement to housing, to construction is needed, especially in such befitting cases. There is a whole case that there should be no capital gains tax. Capital gains is not business. It is just an accretion. And particularly if it relates to a dormant asset like a house, which one essentially needs for one's residence, then that should not be tinkered with. I can understand you limit the number. That is understandable. 54F has a limit. You can have this, but not more than this. So that limit is already there. If you wish over 10 crores, please have a limit on section 54. But I would respectfully urge, please do not put this restriction in. It is most respectfully submitted that it is not called for. I can give one more example of distress. I actually had somebody ask me this query. A man is changing his job or occupation. He is going from one city to another city. He has to perforce sell his house in the old city and buy a place in the new city. Now, has he done business? Has he earned income? Has he invested the money entirely that he receives on sale of such a vital asset back into a vital asset that his whole family needs? Then why are we taxing him, please? And then there are all those, unfortunate things which can never justify, but it may lead to other aspects coming in when somebody's saying, on the sums of money involved, which are not welcome at all, of course. Thank you. Ashok Bhai, you may please continue, sir.
So thank you, Anilji. And just to take it up from what you mentioned, what the finance minister seems to say that because it is above 5 crore or 10 crores, this is not something where the benefit is intended to be given. Also, we need to look at the price of the flat in the metropolitan area. And a 10 crore flat today is not a ultra high net worth. So my view is that this itself is wrong, number one. Again, look at it in the insurance. What the finance minister has said is that this is a high net worth individual using insurance for the purpose which were never intended. The point which we need to have a look at it is this are going to come up 15, 20, 25 years from today. And the way in which the rupee is depreciating, would we be able to say that 5 lakhs premium is for the people who are ultra high net worth individual? So again, adding to what Anilji has said is that the finance minister needs to consider this, even if there are some instances where someone might be making the so-called misuse, but that is not a ground to sweep everyone under the same carpet. So that was the one preface. Now, going forward, another change which government has made, this is on an angel tax. Years ago, the government came up that if the companies are issuing shares at a premium, then if you can't justify the premium excess amount over the valuation can be taxed. Quite a lot of controversy has come up on this. More often than not, tax officer would look back 2 years, 3 years down the line. Number two, in a real life world, it is not always possible that shares are issued based on some valuation formula. The government had exempted non-resident from this provision of 56 to 7B. In the current year, they are included them also. Now the point is that in income tax, the government wants to say, do not issue at a price higher than fair value. When it comes to FEMA, they say do not issue at a price lower than fair value. So now the taxpayer are coming into a situation where neither when you are getting into FEMA and income tax, how do you come to a value which is compliant both under FEMA as well as under income tax? So this is going to be a big challenge. Another issue which government keeps on tinkering year after year is on a charitable trust. Over the period of time, taxation of charitable trust has become one of the most complex. 12 new provisos have been added this year, and that is in over and above 65 existing provisos. And there are 50 explanations to this charitable trust. It's a landmine. So what have they now come up? They changed the method of registration, and now you need to apply for renewal of registration at the end of 5 years. The government has now said that if you do not apply within the time limit of these 5 years, then you will be treated as if you have sold all your assets, and you will be required to pay the tax at the maximum marginal rate. Application for renewal, these are all administrative act. Even if for some reason someone is not able to apply, the consequences which the government has given are far, far in excess of the so-called default. There may be genuine reason why a person may not be able to do it. Most of the charitable organizations are not, they are not a business organization where they have a large team of accountant. So again, my view is that on the procedural matter, this is a very, very harsh outcome. Another things which the government has come out, as we all know, that when you want to do a charity, people would have their own trust, and thereafter you will be giving it to another organization. And other organization like hospital, education institution, they are all run by a charitable organization. Till now, whatever money which was contributed was treated as an expenditure on the objects of the trust. On a rational, that of every 100 rupees which the charitable trust collects, you are allowed 15% as a free accumulation, and you only give 85. You can are only obliged to give 85. Now the government has said that whenever you give a donation to the second trust, only 85% of that will be eligible to be counted as an expenditure. And again, the rationale why they are brought in can't be seen. So they would, I would urge that at least on this charitable trust, the government needs to simplify and start trusting the taxpayer. Ultimately, people are putting their hard-earned money for this social cause. Then there are other two minor amendment. The first one says that in order to claim exemption, you could file the updated return within the extended time limit. Now you are required to file the return within the original time limit, and if you do not do it, you will lose exemption for that year. Again, a very, very harsh outcome. And another minor amendment is that there are some forms which are to be filed, Form 9A, Form 10. They were supposed to be earlier filed 1 month prior to filing of return. Now they are brought in about 2 months of filing the return. In last few years, government has taken a very, very positive step for GIFT City, and we are in a position to see the outcome. Quite a lot of entities have set up their shop. So the first amendment, these are all minor amendments which they have made. They have extended the time limit. So in the budget of 21, if the funds were to relocate from a domestic to IFSC, they had given time till 23, and if you were to relocate, both the fund as well as the unit holders were not liable to tax. Now this time limit has been extended by 2 years to 2025. It will ease the people, the persons who have set up the fund in a domestic area to shift. Second thing, which again, which is on a simplification of procedure, is that now they have brought all the approval under the single authority of IFSC administrator under the IFSC, and this would certainly help in bringing down the time limit by which you can set up. Another issue which was there was in a case of a business reorganization. What would happen is that the appointed date would normally be for a period much prior to the date when the orders are passed, and when you are filing the return, quite a lot of time goes, and then no remedial action is taken. Last year, they had amended the provisions to say that post-merger or demerger, you could revise your return. But now that they have made it more clear that the assessing officer has to act on this. For NBFC, they have that thin capitalization rule, which was not applicable to banks and institutions. They have extended to NBFC also. That is also a wise move. So thank you, and others, I'll take it over to.
Mr. Chopra, are you there?
Yes, I think they're just reconnecting me. Can you?
We can hear you.
Yes. So yes, they've got me back. Yeah. Thank you very much, Ashok Bhai. Thank you. The stated policy of our government and finance minister is to have an empowered, inclusive economy, which is also driven by technology, knowledge, capital, and a robust financial sector. Startups, 80,000, unicorns, 100, third highest in the world, is also something, thanks to government policy, that we are all proud of. And there is more to come. The angel investor is an intrinsic, important part of startups. This is a global model. It is not a model only for India. If aspects are done which will restrict free transaction and justifying value between unrelated party, reputed foreign party and India. Again, as Ashok Bhai, you mentioned trust. We have to trust our people. We are saying that we are moving on the cutting edge of what is the best in the world. Then we must enable our startups and unicorns to do business here. How can Mr. B, C, or D decide what is the value? It can be justified, that's different. But then how do you justify certain situations? Some of these technologies or valuation methods or bases are so unique. You may have a loss-making company which for various justifiable reasons has high value. It's again global. It is absolutely has testimony of so many instances globally. Then why are we artificially bringing these things in? Why do they need to be pursued? Why can't we have ease of business? This is very, very important to be seen, Ashok Bhai, as you have rightly said. We must give the right impetus to our business in keeping with our policy. Some changes which are appreciated, some are procedural, some are consequential, but they are welcome. Conversion of gold to electronic receipts, gold to electronic receipt or vice versa is not transferred under Section 47 if it is done through a SEBI registered vault manager. The cost would be taken to be the cost of the original asset before conversion. And similarly, the holding period would include the holding of the original asset before conversion, be it gold to EGR or EGR to gold. These are excellent provisions, very welcome to avoid artificial tax on an artificial basis. Keeping with, again, if I may say so, it is consequential 194R from 1423 TDS. Now, government is very clear, it is benefit or perquisite in cash or kind. And they have clarified that, so whichever way it is, tax has to be deducted at source. Interesting further, credit mismatch, enabling provisions. If there is a credit mismatch in TDS between the year of accrual of income and the year of deduction of income subsequently, then you can make an application to the AO in the prescribed manner, in the prescribed time, and he can rectify your assessment order or intimation as may be in keeping with those circumstances. 244A interest, however, will be from the date of application till the date of refund. And certain further consequential provisions are there in this matter. In 206AB and 206CCA, notified persons exempted from the section. These include those who are not filing returns, who do not need to file returns, and that class which is notified by the government. So again, it is to create ease of business and to prevent hardship to such people who do not have taxable income. On 194R, S and BA, penalty provisions have been brought in for default in TDS. Well, this is, again, in my mind, consequential. There are provisions. If there's default, then there will be penalty provisions. And in fact, it may stretch to prosecution in the prescribed circumstances. We then move on to reassessment. Here also we know there has been a lot of issue on due process, timelines, opportunity show cause notice. And on the flip side, assessees have sought a lot, courts have given fair relief, courts have sent back the matter to be redone, and Supreme Court particularly intervened in a manner which was just and fair. Rather than knock off tens of thousands of cases, a further opportunity was given to comply. Having said that, the timelines for reassessment, in all fairness, have been now modified, where in certain specific situations the time is short, then it will get extended to give a reasonable time to the AO to issue the notice or to issue the 148A order. So where the search happened after 15th of March, before 31st March, and the last date was 31st March, then the date will get extended by 15 days. Where the time is short for issue of order under 148, if there is less than 7 days, then 7 days time at least will be provided. Where for assessee's compliance, so that he also fully complies with his obligations, where a 148 notice is issued, post-search and post-requisition, the assessee must file the return in response to 148 notice 3 months from the end of the month in which the notice is issued. Issued is the key word here, or further period that may be allowed. If he does not do so, he will lose all the benefits of a return under Section 139. For instance, no notice is required to him under Section 143, subsection 2. For instance, he may not be eligible for brought forward loss because he has not filed his return within prescribed time of 139, and that may be a view which is adopted, that in this case you are not a return filed in 139, so you are not entitled to the loss. And there are other consequential aspects such as who is the prescribed authority when the period involved is more than 3 years, protecting because it is going higher up, and that prescribed authority has been kept as high as Chief Commissioner, Director General, or Principal Chief Commissioner and Principal Director General under Section 151 of the Act. Here also, if under Section 149, there was some extension of time because the number of days with the assessing officer was inadequate, between 15th March to 31st March, similar extension would be allowed for certain actions thereunder. Thank you very much, everybody. And I will hand it back to Ashok Bhai and Dhruv to take it forward.
No, thank you. This was a very productive hour. And before we're spot on time, it's 5:35. Of course, I would like Sandeep Bhai to wrap it up. But before we do that, I think it'll be great to get Ashok Bhai, you first, on your, just to encapsulate everything that you've read. If you had to rate this budget or give a view, and I'd like Mr. Chopra to do that. What's your takeaway in summary?
See, basically, she has kept her word. So if you see, there have been no retrospective amendment in this, hardly any retrospective amendment, even where they wanted to curb some of the provisions that have been brought in prospectively, a very, very welcome move. Second is her impetus to go for a simplification. So all the provisions which she's giving on a presumptive tax, on personal taxation, is to go on a incentive-less taxation system, and she's moving in a right direction. She has reduced the taxes to some extent for the high net worth individuals and across all the categories, and most importantly for business also, the taxes have been kept steady. So from that angle, she scores really, really well.
Mr. Chopra?
Yes, I would agree with Ashok Bhai. It's a very good budget. The budget has to focus essentially, finally, on the common man more than others. On those whose need is more, must be focused on more. But it is now understood and appreciated that there is a multiplier effect, there is an indirect effect. Business, investment, capital expenditure, these create economy drivers, which create jobs, which create funds which can be used for good purposes. Focus on capital expenditure, infrastructure, education, skilling, technology, and we can go on and on. All of us have seen the 7 key points, and we have seen what Ashok Bhai said: simplification, ease of business. The fact that she is mentioning it in her speech, she is very informed that this is what needs to be done. Be it decriminalization, be it ease of business, be it other factors. In short, it's an excellent budget. Yes, ye dil mange more. And we will be sending a memorandum between the firms to the authorities, putting our point across, and hopefully with everybody seeking what is fair and rational and in the larger interest, hopefully there will be some modifications. Time will tell. Yeah. Thank you.
Super. Before we wrap up, I would like to bring Sandeep Bhai in, the managing partner at NA Shah Associates, to say a few words, please. Sandeep Bhai.
Thank you, Dhruv. And there were 1 or 2 questions. Dhruv, do you think we have time to take that up, or
We've got quite a few people. Pretty much everybody's still online, Sandeep Bhai. So they've been very kind to us, and I think so we can take a few up. Though we're
Okay.
10 minutes above, we can take a few up.
So we can. I think there are 2 sets of questions. Ashok, you touched upon the MSME aspect, and one of the question. Oh no, I think Anilji spoke about the MSME.
That's right.
That one of the question, Anilji, is that if the invoice is of 31st March and it is paid on 1st of April, will that be allowed in the 31st March, or it will go to the next year? And I think you did touch upon the fact that 15 or 45 days, if that's your arrangement, then it will still be allowed on accrual basis. Did I hear you right, Anilji?
Yes, Sandeep Bhai, this will be allowed on accrual 31st March, because the section is very clear. Please read also the memorandum. I would request the queries to please read the memorandum, explanatory memorandum. And the disallowance is only on that which has gone beyond the due date. So it has not gone beyond the due date. Where is the disallowance? The amount that has to be paid and allowed on payment under 43B is only that amount which has gone beyond the due date.
Right. One question, I think, Ashok, you touched upon the TCS aspect, and I think the relevant question which is flowing is that, is there a color to the LRS? So you had specific around education, you had something about the tours, you had something about medical, and then rest everything is under the other LRS. So the question was that if I'm buying stocks, which is also one of the permissible mode of remittance for LRS, will it attract 20% or not? That's one of the questions, Ashok, if you would like to
Yeah,
answer.
it would, because the bank would insist on deducting TCS for all the remittances, which are purposes.
You are right that that handle is in the hands of the bank and not in your hand, because they're going to take away the money from your bank, whether you like it or you don't like it.
Absolutely. I think any permissible current or capital account LRS remittance will attract 20% TCS. And that's been the principle even for the 5%.
Yeah.
So the principle doesn't change, the rate changes.
One question, Dhruv, which may go back to you, is around that whether the change in regime or the second avatar of the new regime, whether is it a kind of a gimmick, whether will it hurt the investment, perforce investment, if that is the question which is coming in. Well, uh, do you have a view there that will it hurt the perforce investments?
Well, I think they've done a very good job. See, essentially, this is incentivizing a larger, wider tax net to participate in the revised new regime, which they weren't able to achieve in what they introduced in 2021 because the benefit wasn't there. It is less, there is less headache, for lack of a better word, involved in adopting this regime. And based on a preliminary assessment, there is an actual cash saving. This is part A. And this, the beauty of what they've done is, like I said in my initial remarks, is not just at the bottom of the pyramid, which is, at the lower income stream, but as you go up, they have released cash all the way up to somebody earning 5 crores. So if you are generating free cash, so to speak, in the hands of an individual, then it will do only two things: either push savings and investments or spending, and both are great for the economy. So I think it's not a gimmick. I think it's not a gimmick. And I think it's the less the paperwork, the less the questions, the less the dispute. And that's really what we're going for. Yeah.
So you are a big canvasser of consumption-based economy that you consume and you allow your children to be on their own feet. That's not safe for our next generation. Well, you are a big beneficiary of Anilji's hard work.
Absolutely. Okay.
But just to conclude, therefore, I think I've covered most of the question, and both to the learned speakers, while you all are in your wisdom going to draft the various representations. But I definitely believe Anilji picking up from one of the topic that whether the presumptive tax should have GST or not. I'm sure around life insurance also attracts an 18% GST, and when they use the word premium, is it plus GST or is it within 18%? So I think that could be one question. Similarly, on startups, there are those questions around GST. There are high rates, so I'm sure. And of course, I also believe that the government, Ashok, in your view, where they would seriously look back on the insurance aspect. I do believe that for those insurance policies where you get money on critical illness, and then it reduces the amount payable on death, I think it would be a counterproductive to the whole insurance industry. So I'm sure I urge all the listeners who spent an hour and 15 minutes with both the firms to put in your suggestions, so that before and while the iron is hot, we could still give the representation to the finance minister for their consideration. Dhruv, thank you so much for putting this entire event together and ensuring that the representatives from both the back offices have enabled this webinar to happen. Thank you so much, listeners. This is the third combined webinar on the different topics. We hope that both the firms put together will continue to bring in diverse topics at a shorter interval, which may be of interest, and contemporary topics. There are more partners with different skill sets, and I'm sure you would be delighted to hear them as well. So stay tuned in. Thank you so much, Anilji and Ashokji and Dhruv and my back office team and the PNC team for this hosting this webinar and listening to our webinar. You have contact@dpncindia.com and you have NA@nashah.com are both the emails ID which are available for your suggestions. Or if you have post this, if there are any questions, please feel free to write to us, and I'm sure the teams will be more than happy to reply. Have a very, very safe and great weekend. Wishing all of you a great 2023. India continues to shine. Thank you so much to all the listeners. Thank you, Dhruv, Anilji, and Ashokji.
Thank you, everyone. Have a great night.
Thank you.
Thank you, everyone.
Thank you. Have a
Bye-bye.
happy weekend.